Welcome to Ethical Exits, everyone. We're super stoked to have Stacey Smith, the Senior Vice President and Head of Programs at Project Equity, with us today. And Stacey, I have to say, I think you're one of the lucky ones, because I think most of us find our way into impact work later in our careers. You know, we play around in the mud a little bit in corporate America, but I think that you got a head start and you have dedicated the bulk of your career to helping businesses align their impact with their values, which is super cool, super fortunate that you have been able to do that. Stacey started as a CPA with Arthur Andersen, so if you have any CPA related questions, certainly she's a good fiduciary. She could do the math and she knows how to read a spreadsheet before she moved into strategy and organizational development, and eventually beginning an early career in sustainability and corporate responsibility, right? So all of those themes. You worked at Business for Social Responsibility, where you spent a decade advising Fortune 500 companies on reducing their negative impact. And more recently, you worked with nonprofits and foundations to tackle structural barriers to wealth and economic equity. That all led you to Project Equity, right? Where you are accelerating the adoption, such a noble mission, of employee ownership as a powerful tool for building wealth and high quality careers. Stacey holds a degree in business administration from the University of Vermont and studied international business at the University of Copenhagen, which I don't know, you don't know this, Stacey, but this is why we get along apparently, because I also studied at the University of Copenhagen. No way. And I studied political science, of course. I studied their parliamentary system, but that all tracks, right? Why we get along. We have a little bit of Scandinavian in us. We've been influenced by their bike culture. I have stories, I'm sure both of us could tell stories about riding bikes in the freezing winter in Copenhagen. But when she's not driving impact, she's hiking the Bay Area trails, exploring the restaurant scene, you're a foodie, or spending time with family. So, Stacey, welcome to Ethical Exits.
Well, thanks so much, Hannah and Caitlin. I'm thrilled to be here. It's been super fun getting to know you guys and just loving what you guys are doing and looking forward to cooking up some more things together.
Awesome. Awesome. Well, so are we. I mean, this is such a serendipitous discovery. When we first learned about Project Equity, for our listeners, if they remember, was from Cameron Medill. Cameron transitioned his company, Pixel Spoke, into an employee-owned cooperative, and he sang the praises of Project Equity. So that led us down a little bit of a rabbit hole, and here we are. Now we have you. So that's super great. Stacey, on this podcast, we always like to start with values, right? As an introduction to our audience, not just what you do for work, but how have your values formed you as a human, right? What are those core values? And how have those values then translated themselves into your work, which you are fortunate that you have done. A lot of folks haven't been able to do that or are made different choices, but you certainly have. So if you could kind of share with us a little bit about the values that form your behavior and your interests, and certainly how you're spending your time.
Absolutely. Well, thanks. It's such an interesting question, and I'm pretty far down the road in my career. And so everything makes a lot more sense looking in the rearview mirror. I will say that. I grew up in the Midwest, and my dad was an entrepreneur, and my family were actually libertarians. And I got exposed to a lot of thinking about individualism and capitalism, et cetera, et cetera. And I went to college and I studied abroad, and this was in the 80s, and there was a lot of interesting things going on in Europe at that time, and the Berlin Wall was up, and there were a lot of questions about, capitalism and the role of capitalism versus other models. And I sort of early on decided that I thought capitalism was a good thing. And I think it had some complicating issues around harm and whether it could really fulfill the potential that was promised with capitalism. And so my career really has been about exploring that. And how do we take what I believe is a fundamentally positive model in so many ways that sometimes gets corrupted and gets off track, and it doesn't really deliver the promise that has been made in it. And so As you mentioned, I did start my career early on in the public accounting space, which was basically like a paid MBA. I got exposed very widely at that point in my career and understood a lot of different industries and sectors, and understood financials and how companies make money, how they spend money. And then I diverted myself into the world of sustainability, which was nascent in the United States in the late 90s. And it was just super obvious to me, though, that large corporations had a role to play, and it was a strategic role. It was strategic
Mm.
in terms of problem solving, but it was also strategic in terms of being able to grow their business and really not do harm at the same time that they were manifesting their strategies. So that was a thrilling ride for 10 years while we really established the corporate sustainability practice in the United States in the early 2000s. But one of the missing links for me was always scratching our heads, like, how do you impact the individual communities, and how do you really help communities build up and sustain themselves over time? And there are some answers to that, but none of them were really compelling until I learned about employee ownership, which was nuts that I didn't know about it. And that's actually one of the issues that Project Equity, our organization, is trying to solve. It's been one of the best kept secrets in our economy for decades and decades, and we're working really hard to crush that because we don't want it to be a secret anymore. And that's what happened to me when I learned about it. And I was like, well, this is it. This was the missing link. And again, it's a wonderful economic tool that we have to drive community outcomes, individual worker outcomes, and outcomes for entrepreneurs who are taking such big risks with their own time and capital, and really delivering them an exit for these businesses that they build up over time. So it's been a thrilling, run, and I've been very fortunate to feel that my career really intersects with my values, and that I've been able to do some substantial things with that.
Did you know that Unilever's sustainable living brands, obtained through strategic acquisitions, expanded 69% faster than the rest of their portfolio? This business strategy isn't just for giants like Unilever. You too can execute a similar model to drive growth and impact. At Up and Over, we specialize in helping mission-driven companies grow by acquiring like-minded businesses. Ready to build your own portfolio of impact? With Up and Over, it's within reach. Visit upandoveradvisors.com to learn more.
And you've been able to take the hardcore talents that you have and skills to this space, right? A lot of it is math. It continues to be math and spreadsheets, right? Which we'll get into certainly as we learn more. And I certainly want you to share more about just like the fundamentals of employee ownership, the different structures that are available for our audience, because a lot of our audience they are entrepreneurs, founders of running impact businesses, and they are looking for not only an ethical exit but an ethical way to operate their business. That I think I've never heard it described the way you did just now about capitalism's purpose to fulfill. How did you say it exactly? You said to fulfill its promise.
Yeah.
Such an interesting concept, and just to sit back and think about. It's like, what are you talking about? Capitalism is just supposed to enrich the individual, right? It's especially now with the billionaires that we have. It's a winner takes. It's been really corrupted, right? It's become more of like a cancerous cell where it's all about accumulation to one source, right? Winner takes all. There's a lot of predatory capitalistic practices that are happening now in the space that we're in. It's 2025. We have a new president, right? We have a new affiliated office of Doge, right? That is having a large outsized impact right now, as we know, on workers, right? And our democratic foundations, all these different organizations. So it is really interesting to think about. I think most people think about capitalism as a vehicle to enrich and empower individuals. But the way you think about it, if I'm understanding you, or the way that you frame it, is no, capitalism is a economic vehicle, but that has attachment and responsibility to the community in which it operates.
trickle down economics is something that, many people either heard about or learned about, but never dove deep enough into. And that's where I think there is a breakdown, and where I think employee ownership, when we're talking about democratizing, in a way, the ownership of the equity of our, these wealth generating and value creating entities in our economy, that's what's so exciting to me, is it really does that.
Absolutely. So let's go right into that then. Let's talk a little bit talk to us about your work at Project Equity, what you do there, the fundamental basics of employee ownership. I mean, I know you do this often, so, but it's still, I mean, to your point, like a big part of what Project Equity is trying to do is get the word out, raise the floor of understanding of what employee ownership is, what the promise is, and the different vehicles that all businesses of all shapes and sizes can really adopt, or they can at least plan to adopt, right? If it's not immediately available to them right now, how can they think through those different vehicles? So if you could just kind of start with us, just the basics, understanding the premise that there's probably a lot of people that know the word, have heard the term, but they have no understanding outside of what that means, outside of like maybe their local organic grocer is a co-op, right?
Yeah, and that's not a great example. So let me dispel some of that pretty quickly. So Project Equity, we are a national 501c3 organization that is working to scale employee ownership in our economy. Talk about the ways in which we do that, but let's talk about what employee ownership is first, because that can mean a lot of different things to a lot of different people. So right now, in the movement that we are a part of, when people say employee ownership, what they are talking about is broad-based ownership of the equity of a business by all of the employees. And so what that means is it's not a key person buyout. This is not about, the three guys who are the, senior leadership team going and getting some capital to buy out the equity. It's not about stock options. It's about really these forms of broad-based employee ownership that we have in the United States. And we have three very common ones right now in our country. One is called the Employee Stock Ownership Plan, and that is also known as an ESOP. We have a worker-owned cooperative, which you referred to, which is a business that is owned by its employees, so by the nature of it. And then we have something called an employee ownership trust, which is trust ownership, but it's trust ownership with a focus to benefiting the current and future employees of the business. So in each one of these, all of the employees have the opportunity to be owners of the business. And that's what we mean when we say broad-based employee ownership. And so these are mechanisms that can be used across many different business sizes. So if we talk about middle market companies, those companies that, arguably are sort of 50 to 300 million in revenue, typically they might be looking at an ESOP form for that ownership. If we start to look sort of at smaller businesses, sort of lower middle market, an ESOP might work there, but then we're really getting into these other forms, an employee ownership trust or a worker-owned cooperative, that are going to be a better fit for those smaller companies. And then when we get to what we call small businesses with maybe 10 million or less in revenue, that's where the worker-owned cooperative or the employee ownership trust really becomes a great option, because those businesses are a bit too small typically to be looking at the ESOP. So the good news is that we have a form of broad-based employee ownership for almost any business in this country that wants to really retain some private ownership. So at Project Equity, we do a couple of different things. One, we are working to scale employee ownership. So we do an enormous amount of awareness raising, education. We educate advisors, so attorneys, CPAs, exit planners, et cetera, so that they understand this option. and they can bring it to their client base. And we also run a boutique M&A advisory where we are exclusively transitioning businesses to these employee ownership forms. We also have capital that we bring to these transactions so we can be sort of a one-stop shop for business owners. So we love all that. And the reason we love it, sort of getting into the why of employee ownership. So many business owners have been stymied when it comes to succession about what is the right path for them to take. One of the reasons for that is they wait too long and they have a sense of urgency. They don't feel that they can get decisions made and execute what they really want in the time frame that they feel that they have. So we can back up that process a lot. But the other thing that's going on is most folks hear about somebody else unrelated coming in and buying the business, and I heard, oh, that guy got an offer from his competitor, and this guy got this, offer from private equity. And it's a very reactionary kind of response. But when we talk to business owners, and we talk to about 200 individual business owners a year about this, many of them have a much more diverse sense of what is important to them when they're talking about exiting this business that they spent decades building. And certainly, like, sale price is important, right? Because they need to realize the investment that they've made over this time. But there are a bunch of other things that are important. And that's where I think, with your audience of, B Corp business owners, they've already looked at themselves and at their business and said, wow, there are a lot of things that are important to me. And it's not just about, the exit or the amount of money that I'm harvesting. So legacy, community, jobs, employee reward, employee retention, all of these things are different motivations. And each business owner has their own complement, and they would weight these different things differently. Interestingly, though, employee ownership, broad-based forms of employment, they can tick all those boxes. So we can go get a fair value exit. We can bring capital to the table, so there's cash out. We are now positioning the business to meet employee engagement, retention, and productivity goals, because not only are the employees invested in the business because this is where they work, but now they have the equity in the business as well. So you're matching internal and external incentives for a workforce, which has, study after study shows what that does in terms of retention, recruitment, and productivity. It's just phenomenal.
And profitability, right?
And profitability, yes, all of that drives down to the bottom line. So in the research where we're comparing employee-owned businesses to non-employee-owned businesses in the same sectors, you're seeing the employee-owned businesses, track higher, anywhere depending on what you're looking at, the stats that you're looking at, trending higher than their non-employee-owned peers. And what we also saw during COVID was the employee-owned businesses did not have to retrench as far as the non-employee-owned businesses. And so they were able to level out that very tremendous shock to the business model, again, because there was so much aligned incentive that employees were able to work together and pivot to position the business better. And we have a great story of a cleaning business in Minnesota where it was a non-essential business at the time, so they were shut down, and the employees, it's a worker-owned cooperative, the employees came together and said, how are we going to get through this? Because obviously it was important to them that this was where they worked. It was their livelihood. And they were able to pivot and started, selling cleaning supplies and instructions and videos and other things. And they were able to bridge that period of time where they had to close down and they weren't allowed to go into these spaces and do their actual work. It's just a tremendously inspiring story in that way. So all of this said, Hannah, employee ownership is a really important mechanism for business owners who are looking to exit, as you say, and we are also increasingly using all of these forms of employee ownership for what we call partial transitions. And so what that means is we're not doing all of the equity at once, but taking a portion of the equity and putting it in this broad-based employee ownership form as a way to catalyze those benefits of productivity, retention, engagement, et cetera, as well as giving the employees and the business owner a vision for where the business is going down the road. And it's almost bookmarking that this is where we're going. We're going to go to this place of full employee ownership. We're getting on a path now. You all can all come along for the journey here. And that way, the selling owner also has bookmarked that for themselves. So they have the peace of mind of like, now I know what my exit is. And now I can grow the business toward that exit. And it's already in place. So to some extent, the work has already been done. And over time, you're just going to transfer the rest of that equity into there. So this partial ownership play is so important, particularly for business owners sort of in their 40s and 50s who may not be ready to fully exit, but maybe want some liquidity now in order to go invest in something else or do something else that they want to do at the same time as, keeping the business growing.
Yeah, so much of what you said there really resonated with me. One of my favorite sayings, it's really simple, is no one is as smart as everybody.
Yeah.
And I think Cameron, our friend Cameron from Pixel Spoke, kind of shared that same kind of idea, because he said when he transitioned, and he took a slower, it was a slower process. I think it took Cameron a couple of years, right, to fully transition out of the company after he initiated this employee cooperative process with your help at Project Equity. He talked about that those years where he was running a cooperative were the happiest years of his tenure as CEO. Because even though, and I certainly want to talk about these misconceptions, even though the managerial structure stayed in place, right? Just because he transitioned into employee cooperative didn't mean it turned into a free for all. Now you have all these different department heads, or decision makers. It doesn't work that way. That's a common misconception. But even though that managerial structure stayed in place, because all the employees had equity, right, were bought in, they shared more. And Cameron didn't feel so alone in the decision-making process.
So important.
Right?
Such a great point.
So huge. So for him, and he talked about the loneliness epidemic of CEOs and founders. And, that's such a common story of where people are just so stressed out. It's hard to be an entrepreneur, all that financial stress, all the stress of knowing that you have people who are counting on you. And, everyone's looking to you to have all the ideas. This modal really unlocks a lot of those doors where everyone feels better. Everyone feels like they have more opportunity to provide input and to do more. So I thought your example of the cleaning company was really powerful. They were a service-oriented operation. And during COVID, when that was no longer available, they transitioned into more of a product-oriented operation, right? Which worked out really well. But now going forward, post-COVID, they have both, right? They have
Exactly.
different
That's
revenue
exactly
streams.
right.
They
It's
have diversification. Yes, absolutely. Let's dig in a little bit more on these different structures. ESOPs, as I understand it, have you shared with us, ESOPs really are for the higher end of the market, whereas employee-owned cooperatives and EOTs, employee-owned trusts, can be more for like where a lot of the companies that we talk to, these mission-driven companies, B Corps, especially in the United States, tend to be a little bit smaller. A $10 million B Corp is fairly good size. So they're going to be more in those two buckets. But just thinking about feasibility, right? Like the must-haves to even consider any one of these options. Jump in here, but I think that they're first and foremost, you have to be profitable. Right?
Yes.
You have to have some EBITDA, more EBITDA if you go ESOP, right? Million plus, ideally, but that's even at the lower end because it's expensive to transition to an ESOP.
That's right.
There are lots of benefits there. The benefits are bigger from a tax perspective on an ESOP, but profitability for any one of these models is key. Especially if you're using it as an exit strategy, there has to be profit there. There has to be equity for this transaction to happen. Another thing is buy-in. Do your employees want equity, right? Have that open conversation with them. Do you have staff that's more long tenured, or that's hanging around, or that has retention already built in, or do you have people coming in and out? That can also kind of alter, or maybe can shift some of your choices that are available in the three, right? But having that kind of open conversation and buy-in from staff is an important conversation to have. And then an exit or some sort of succession strategy, right? Do you feel like the business is operating in a good place? As Mackie McNeil talked about it, do you have a wheel? Have you built a wheel, or have you built a fulcrum, right? Is there, if you leave, is there a good structure in place? Do you feel confident that the company can survive without, without someone just right at the top, right at the apex of the organizational structure? Those are the main ones. But what else would you say, Stacey, that are kind of like must haves to consider this?
Those are some good ones, Hannah, for sure. I think I'd back up a little bit though and start with, we're looking to take going concern businesses that are healthy, thriving, and growing, and selling them to a buyer. And the buyer are the employees. And the employees are not going to buy a lemon. So if the business is not performing well,
Yeah.
it's not a good option for employee ownership, because this is not that's not what we're looking to do here. These are not turnaround situations. So a turnaround situation is going to require some outside expertise and some outside capital to come in. So these are strong businesses in and of themselves. And so when we talk about strong, it's some of the things that you've said. So, first and foremost, is there a strong operating model? And is the business able to generate a profit under existing operations? Second, does the business have low debt? Because these are leveraged buyouts, meaning the way we're going to buy the equity from the selling owner is to bring some debt financing into play. So if there has to be debt, what we call debt capacity in the business. So if the business is already loaded up with debt, or with some preferred shareholders that are, convertible notes, that kind of thing, then it's going to be more complicated, or the value is not going to be as high potentially as the selling owner is wanting. So that debt is an important piece. And then, as you mentioned, like having a line of sight to the management succession. So just because it's employee owned does not mean that suddenly we are blowing up management and governance. In fact, we're going to in many cases, get more serious about it. So all three forms of employee ownership will involve a governance layer. So there will be a board of directors when there maybe hasn't been an active board in the past. And that board is going to oversee senior management. So there is absolutely a role for senior management, and senior management has to develop strategy and execute strategy as well as operations. So that's a really important piece. And being able to have a line of sight to who those folks are going to be that is going to do that succession. And in some cases, we might have to go find somebody external to come in and fill some gaps, or there might be a longer runway to developing some internal capacity in that regard. So you mentioned EBITDA. And the other thing we want to mention is the number of employees. So for what we call micro businesses, businesses that are, less than 5 or 6 or 7 people, these ownership forms are clunky at that size. So we really want to see businesses like 10, 15 plus employees. That 20 to 100 is like absolutely a sweet spot for worker owned cooperatives and EOTs. They can both scale higher than that. But the real micro businesses, we have some alternatives in that case to achieve something that looks and acts like broad-based employee ownership, but may not involve all of the mechanisms that well-known forms include. So those are some of the readiness factors. And you brought up talking to the employees, and that's interesting because we see it going both ways. So sometimes really the owner is really exploring these things because ultimately they're in control of the business because they own the equity. And so the timing of engaging employees, there's really a broad spectrum there. Some owners want to engage key employees very early in the conversation and then spread it out from there. And some want to really get much more of a grasp on what their path forward is before they start engaging the employees. So it works no matter what.
And I also feel like there's like a common misunderstanding when being introduced to this type of model that the employees will have to pay, quote, like out of pocket to buy the business, but that's not true.
Yeah, that's such a great point. Thank you. So when I was saying that these are leveraged buyouts, right? So there is going to be debt involved to buy the equity from the selling owner. But the interesting thing with broad-based employee ownership is that is not individual employees going and getting loans. So and that's where, sometimes a key person buyout or, those 2, 3, 4 managers who want to come together and buy the business, they're going to be stuck having to go into the capital markets for small business loans and maybe look at SBA lending and that kind of thing. They're going to have to put forward a personal guarantee. They're going to have to put their own assets at risk. When we're doing broad-based employee ownership, that is not the case. The business itself will take out the loan, and the business itself secures the loan and pays it back out of operating profits over the term of the loan. Individual employees won't have their credit checked. They don't have to put forward a personal guarantee, and they don't have to scrape together the down payment. So that's another really important thing when we talk about there is a ready-made buyer for most businesses in their employees, because we do have this special capital that can come in those situations and really facilitate making these transactions happen.
That's excellent, Caitlin. Thank you for bringing that up, because that is, and you mentioned this, Stacey. You just said this quickly, but Project Equity does have a capex fund. You do have a fund available. So as part of your services, if I'm a business owner, I'm considering this transitioning to an employee ownership structure, you can not only help me identify which one's the right one for me, right, based on all my goals, right? You can help me execute that, and then you can also help me find capital to do this.
Yeah, that's right. That's right. Full service M&A advisory over here. Very happy to help.
And then post transaction, also you can guide folks on helping to establish your structures or help with ongoing mentorship as well.
Yes, that's right. That's right. So we do, just in more traditional terms, we lead the deal team and provide that technical assistance in driving the deal team forward. We don't have attorneys on staff, so the businesses we have there's fantastic attorneys who are employee ownership specialized out there, and we love to work with them. But we do bring the capital, and then fairly uniquely, Project Equity has post-transition support, which we call our Thrive program. And so we will work with transitioned businesses for another 2 years after that transition, where we're really building capacity in the employees to now do the governance and be the owners. We are not doing operational consulting, right? These are going concerns. They know how to run their business. They've been running it really well. But a broad base of employees, particularly frontline workers who maybe never envisioned or desired to own their own business, right? Some of these things are new for them, and we need to build that capacity. So we're going to teach them how to read the financials. So financial literacy is a big part of what we do, training them about how to run governance mechanisms and how a board of directors works, or in the case of a trust ownership, how a trust stewardship committee works, that kind of thing. So we're going to work and make sure that that capacity is really embedded in the organization and taking root before we're really letting go.
That's amazing.
And Stacey, when it comes to that transition process, what is the average amount of time it takes to go from like your exploration phase down to closing the sale? And is it different from model to model, or is it all relatively the same?
Yeah, it's a great question. We like to say, when you've seen one small business, you've seen one small business. And when you've seen one employee ownership transition, you've seen one employee ownership transition. Because, and this is not dissimilar from the rest of the M&A world, each business is unique, each owner is unique. each, business context is unique. And so we're gonna see that. Now, obviously, we've been doing this long enough and have done enough transactions that we can understand and anticipate so much of it. But each one is really unique. So when we're doing this work, so we might talk to a business owner, 2 or 3 times, and then they are just starting to mull it over. And we don't hear from them again for 2 years or 3 years. And they come back and they were like, oh my God, I thought about that. Now I'm really ready to get started. And then, they're ready to move forward. So we call those folks, they're a little more pre-consideration, but seeding these conversations early is really important, so they have time to get themselves ready. I mean, letting go of your business is kind of like raising a kid and sending them off into the world. It's a big deal emotionally. And then there are folks who they've explored all their options, they're super clear, and they're raring to go. And so it really depends on the situation. So we can make a deal happen in start to finish somewhere around 9 to 12 months, and that's bringing some external capital, and that is its own process, so that takes a little bit of time. So in some cases we can do it in a shorter time frame if we've got super clean books, we've got a super motivated seller, if we've got good leadership already in place, and we can get the loan underwritten really easily. We could probably do a deal in less than 6 months. But all of the magic coming together perfectly like that doesn't happen very often.
Yeah.
I'll just be honest.
Yeah. Nope. We need the transparency and we appreciate it.
Yeah. The best time to start thinking about these things was, last week. And the second best time is right now.
Yeah, exactly. What about the capital investment, Stacey? And I know that varies too amongst the models, right? I mean, like the cost to pay for project equity or to like make this happen, right? Like it's not, it doesn't happen overnight and it's not free, right?
Anytime you sell your business, there's going to be costs associated with that. Sometimes people hire a broker and then they're paying a percentage of the deal price. They're hiring attorneys, who are going to typically almost always work on a fee for service basis. And in the employee ownership space, it's the same thing. So you have technical assistance providers like ourselves. Our model is we are a sliding scale of our fees based on the size of the business from an EBITDA standpoint, so net income. So we're able to dial our fees in based on the size of the business, and that allows us to work with smaller businesses and help them through the process. And we can also, work with bigger businesses there. So the cost of doing an ESOP transition is significantly higher because that has significantly more compliance driven in it because it is a tax advantage qualified retirement plan. So there's a large expense in putting that into place. And ESOPs bring with them a lot of tax advantages over time that most folks who are transitioning into an ESOP feel that is a good cost benefit. They're willing to spend that kind of money to transition. And that can be, anywhere from $250,000 well above $500,000 to get an ESOP in place. When we're talking worker-owned cooperatives and EOTs, it's significantly less than that. Like, maybe it's going to be somewhere between, high 80s or 90s up to 150,000. And that's all in. That's all of your attorneys, that's your technical assistants, that's loan fees, et cetera, et cetera. So that's an all-in cost typically.
Talked about employee-owned companies and the statistics and how well they've done comparatively to non-EO companies, right? Founders should consider that. This is an investment, but is it an investment that has high ROI? And I would say also, I would venture, I've never seen this data. I'm sure it's out there though. When you look at acquisitions where you've invited an outside buyer, perhaps one that is maybe more focused on short-term revenue goals, the success rate of those companies post acquisition, I imagine, might look very different than the ongoing success rate, profitability, growth, and scale that of companies that have transitioned and sold internally effectively. to their staff?
I mean, I wish we had like some actual, really good data there. I think there's the business performance that you're asking about, which a lot of private companies don't share that information, so it's hard to come by. But then there's also just the less tangible items there. And so a lot of business owners, are have maybe done a deal in prior in their lives and not been happy with how it went, and others have seen someone else in their industry or their community who have sold a business and have not been happy with the outcomes, and that, like, the feeling good about it is really important for folks afterwards. Again, this is something that you're building from scratch. You've stayed up nights, many sleepless nights. You put a lot of money into it. Watching it take off and grow after you're separating from it it's worth a lot to these owners. And that's what employee ownership really does deliver, for sure. In terms of the profitability of the businesses, all of these businesses, because they are going concerns, we see them continue to be that going concern and start to grow, particularly once the loans are paid off that were taken out to pay the selling owner. So if you're looking 5-10 years down the road, the profitability of these businesses is really scaling much higher. And that's where, just maybe start to segue, that's where we also see the possibility for, having some cash to look at plowing back in and investing and acquiring and grow through acquisition for some of these businesses as well.
I'm so glad you brought that up. How convenient. How convenient, Stacey. No, I mean, I think that's really good. I think, on this podcast, we really wanted to use it as a vehicle to explore what an ethical exit is. What does that look like? How do people go about that, especially if they're impact driven, mission driven businesses, which the majority of our audience is, or they're curious about that. They want to feel good about what they do every day at work, right? They don't want to just enrich themselves. They want to have an impact that they care about. They want to solve problems that they really care about. That's what differentiates this audience. And if for our primary business Up and Over, we think that our thesis is that acquisitions, M&A, can also be a force for good, right? So not only can you exit, right, which I think EO is certainly a highly qualified ethical exit. You can feel really good about that. It's a really successful model. But is there room for EO to play a role in scaling, in growing, in acquiring other companies? Can that be a unique and interesting lever? And I have to say, that was not my idea. When I first reached out to Evan, right, and following up to the conversation with Cameron, I just very genuinely just wanted to learn more about employee ownership structures as an exit strategy, right? Like, what's more to learn here? Because Caitlin and I were like, what? Well, this sounds great. We don't know a lot about it, but we're curious. And Evan was the one who was said, like, wait, what do you guys do? Oh, you help mission driven businesses buy other mission aligned, or maybe not mission aligned, but they want to accelerate their mission by and grow and scale by acquisition. We have this capital fund and we would like to get involved more at that juncture, right? So that to me is fascinating because, again, going back to where we started in this conversation with your values, you see capitalism as potentially a moral mechanism, right? That it can have impacts on our communities. It can fulfill its promise, and maybe it just takes. And I think you're really open to this idea, which is great. It's like, okay, how can we change the aperture a little bit? How can we rethink these traditional capitalistic levers in maybe a new way, right? So I think that's where we can see EO as not being more than just an exit vehicle, but how does it maybe be? It can work in an acquisition process. And I'll start by giving an example from the ESOP structure. So you kind of have highlighted or said, you touched a little bit on this about the tax benefits. And one of the things that differentiates an ESOP from a worker-owned cooperative or from an employee-owned trust is it's a qualified retirement plan. That's how the IRS looks at it, right? So it is a non-taxable federal entity, right? That is very interesting. From a lot of different, I'm sure a lot of business owners, their ears perk up on that, right? Because that's pretty interesting. That can create a lot of free flowing capital when you transition to that model, and you could take advantage of that. And you mentioned that sometimes when companies convert into an ESOP, they leverage that free realized additional cash flow to go start buying other companies. Yeah. And we've seen that. I think it's called a rewarding roll up. I think that's what Forbes kind of described it.
Right? I haven't heard that term. That's interesting. Yeah. I'll have to look that up.
Yeah. So in contrast to, other maybe models where private equity or other entities are buying in vertical. So let's take your example of a cleaning company, right? Cleaning company that's a service company and a product based company. It makes sense. Okay, where they're operating in New York, now they want to operate in Vermont. So instead of starting a new company there, expanding there, the way that they expand is they buy a company very similar, maybe that's in Vermont, and now they take that territory and they grow that way. They scale that way.
Mm-hmm.
If they were an ESOP, then they would bring that structure to that next company, right? Potentially, that would be part of their acquisition strategy. They would be able to leverage the free flowing capital as a way to be able to purchase that next company in Vermont. And what an awesome message to those employees that are now part of that newer structures. Hey, we got a good thing going on over here, and we're going to share it with you.
I was thinking too, there's also, a misconception, I think, on the other side of the spectrum too, right? That if you're selling to your employees, then it's going to require you to accept a lower selling price. And that's also not true, right?
No, that's right. I mean, all employee ownership transitions are happening at fair value.
Mm-hmm.
So let's be clear, though, that's not strategic value.
Yeah.
Mm-hmm.
So that's not somebody coming in and giving you 10x EBITDA, but anywhere from 3 to 5.5x EBITDA, we definitely see that. That is considered fair value. When you're doing an ESOP transaction, actually, you have to have an independent valuation,
Mm-hmm.
and the sale price will be pegged to that independent valuation as well. The number of businesses now really looking at using employee ownership forms as almost like a holding company structure to go acquire other businesses and roll up underneath them is really growing. It's a really exciting area of the broad-based employee ownership space. Now, just for an individual business who's looking to make an acquisition, there is also some applicability there as well. So, particularly I think for the B Corp sector, as I mentioned before, I think there's so much alignment fundamentally between the values that are expressed and driven toward in the B Corp space are so aligned with what we see in the employee ownership space. This uplifting workers and jobs, ensuring really sound governance,
Mm-hmm.
transparency of financial practices and performance, and what we call business literacy, really making sure everyone in the organization knows how this business makes money, how it spends money, so that everybody can be involved in driving that.
Mm-hmm.
So there are really some really wonderful overlaps and I think synergies between a business that is being run with a B Corp framework and mentality, and adding on this dimensionality of ownership as well, and having an ownership structure that is really aligned and well positioned to express those values. So at the time that a business is going into the marketplace and looking to say, hey, growth by acquisition, we think it's for us, we want to start to look at this. That's a great time to start exploring the ownership structure itself at that moment. And particularly because there is capital out there And so if a business is looking to make an acquisition and is also looking for that capital to make that acquisition,
Yeah.
if there's a willingness and interest to go ahead and do a partial transition into an employee form, either for the acquiring business or the target business or the new co,
Mm-hmm.
then there is some additional capital that could be brought to bear in that transaction. And I think that's an important and exciting area that we're looking forward to exploring with you all.
It just opens up so many doors, and I get excited when we look at things a little bit differently. We just kind of shift the aperture a little bit. I think so much positive change happens there when we look at it with fresh eyes, or we try something new, right?
Yes.
So I know, Stacey, we've talked about this is like a new idea, at least for our two companies. You guys have never done that before, right? Use employee EO structures at the time of an acquisition. We certainly, in our sourcing activities, haven't helped a company yet. Knock on wood, this will happen this year. That we're working with somebody who we're sourcing for them an acquisition target, and at the same time we're helping them leverage EO structures and your capital fund, maybe to close the gap if they're undercapitalized.
Yeah, I think that's exactly the possibility. And whether that all comes together or not, I think the exploration, and then there may be some sequencing, like maybe there is, setting up the EO form first and then going and doing the acquisition, or getting the acquisition done, as fast as possible. And then on the backside, looking to recapitalize through an employee ownership transition. I think it's all possible. And again, every deal is unique. Every acquiring business is unique and every selling business is unique. And so figuring out the right path forward. And that's one of the things that, I love about Project Equity and the team that we have. Like, we are deeply committed to the outcomes. And we've got great processes in place, and we've learned a lot over the years, and our processes are honed really well, but we are very focused on the outcomes, and we roll up our sleeves and bring a lot of creativity to every deal that we're working on to make sure that it's going to be successful and hit all of those success markers.
That's so cool.
Fantastic. We're now talking to a lot of B Corps on a global scale and a lot of social enterprises. Is this particular model something that you've seen implemented in other, territories, geographies on like a global scale?
Yeah, absolutely. Absolutely. So there are strong employee ownership movements, around the world.
Mhm.
And a lot of those, like Canada has just done some amazing things. They're really investing deeply in the employee ownership trust
Mhm.
structure and passing some national legislation to help drive that, and putting in place some incentives for that. We see employee ownership trusts really uplifted in the UK and on the continent in Europe. We see the worker cooperative structure also really thriving on the continent and in Australia. We also see a lot of activity for both employee ownership trusts and worker owned cooperatives. The ESOP is unique to the United States because it's built around our regulatory, our regulations in the Department of Labor and the Internal Revenue Service. So that's pretty unique. But the other forms of employee ownership, we do absolutely see a lot of work. And in some cases, a lot of countries are well ahead of the United States. And we're learning a lot from Spain and Italy and the UK and others in this regard. So it's all very exciting.
Awesome.
Stacey, is there anything else that you would say about founders who are kind of worried about this work, either for an exit or for an acquisition, where they feel like it might be too complex or risky or expensive? I mean, what are the kind of common misconceptions that trip people up that maybe is good to clear out?
Yeah, well, I think for any business owner, whether they are contemplating an acquisition or they're looking down the road to their own exit, we always want people to be well informed and to look around. And I think it's really important for business owners to talk to their advisors, to talk to others who have walked the path. We are constantly putting business owners in touch with other folks who have walked the path so they can have a
Cool.
one-to-one conversation and really understand that. In many cases, their hesitancies are born of a lack of awareness and understanding. And so that process of really diving into the questions and getting the questions answered helps move them to a place where they feel much more comfortable about this. These transactions are happening with increasing frequency, which is so exciting. And so there's much less of a risk of like, it's not going to work out or it's too complicated. Certainly it's not too expensive. When you look at the cost of selling a private business anyway, it's pretty expensive. And you're going to a broker and getting a broker and attorneys and CPAs and everybody else involved. It can be
millions of dollars. Yeah.
Yes, and upwards of 5-10% of your deal price. And in almost every situation, employee ownership is going to be less expensive from a transaction cost standpoint than that. So that's great news. And we talked about like, there's capital out there. So these do not have to be seller financed exclusively. Often a seller will carry a note for a small portion of the overall deal price, but there's a large amount of cash up front because we can bring these funds to bear in these kinds of transactions. So like I said, we talk to about 200 business owners a year. We love talking to business owners. Each of those conversations is very specific to that business owner, their motivations, their situation, their timing, and helping educate them so that they have a good information to compare as they're going into the analysis.
Excellent. And your website is projectequity.
It's project-equity.org.
Excellent. And there's tons of resources there, all the things that you mentioned. So that's a great place to start if you're curious.
Yeah, and we can give you some links for the call note, podcast notes, or whatever works best for you all.
Awesome. Okay, well, let's close then. We always like to ask our guests what charity or cause is close to your heart so that we can highlight for our listeners and encourage them to take a look, learn a little bit more, or maybe even support. What's yours, Stacey?
Well, I mean, it's employee ownership. And it's, making sure that employee ownership, becomes absolutely the first thing that anybody thinks about in terms of ownership structure, particularly for values aligned and mission aligned businesses. And as I mentioned, we're a 501c3. So, we are a charitable organization, and our foundation supporters, our donor supporters are all helping to subsidize the work that we are out there in the field doing. And we are certainly not the only nonprofit working in this space, I think, importantly. And there are others. And particularly if you're listening, in a certain region, there might be a local provider of employee ownership support and information, and supporting those local organizations as well is super important.
Excellent. Well, thank you so much, Stacey. We loved having you on today and all the information you shared. I think it can help a lot of people get their ethical exit and or acquire and grow in a different way.
Well, we're super excited for that.
You do an excellent job delivering this type of information that's very digestible. So thank you. Me and Hannah are very appreciative of you coming on.
Well, it's a pleasure. It's a pleasure to be here with you guys. And, the vision is super exciting. So happy to be a part of it.
Awesome.